Have you heard the buzz around Vedanta? I mean, this stock has been on an absolute tear and everyone's talking about it. So what's the deal? What's really behind this incredible rally? In this breakdown, we're going to get into everything you need to know, from their huge restructuring plan to the pretty serious risks that could throw a wrench in the works.
So it all kicked off with this one number, 618 rupees and 25 paise. Vedanta's stock didn't just hit a new high, it absolutely smashed its 52-week record. I mean, a jump like that, it gets everyone talking and raises a big question for any investor watching.
And here's the million-dollar question, right? Is this spectacular run a golden opportunity to jump in, or is it a classic trap? Is this the real deal, or is there a catch hidden just beneath the surface? Well, let's dig in and find out.
Okay, so first things first, let's just look at the hard data. Because the numbers behind this rally, man, they tell one heck of a story about the sheer momentum we're seeing with Vedanta stock.
And that new high? That's just the tip of the iceberg. The stock is up over 35% just this year. Then you add a really attractive dividend yield of around 6% and a market cap closing in on 2.4 lakh crore. You've got a company that's just, well, impossible to ignore.
And to really put that 35% game in perspective, think about it this way. While the broader market has been doing okay, Vedanta has absolutely crushed that average, more than doubling it. So this isn't just a case of a rising tide lifting all boats. No way. There's something big and specific going on here.
So, what's the engine behind all this? What's the big secret? Well, it comes down to a massive, and I mean massive, corporate shakeup. Vedanta is basically hitting the reset button on its entire structure, and that's the #1 reason investors are getting so excited. And the reason everyone's talking about it now is because of a huge green light from the National Company Law Tribunal, the NCLT. This stamp of approval means the whole demerger plan isn't just an idea on paper anymore, it's happening, for real. And the market is reacting to that certainty. Okay, so how is this whole thing actually going to play out? It's pretty straightforward, really. Step 1, the NCLT says go. Check. That's done. Step 2, Vedanta Limited, as we know it, is going to split into 5 completely separate, publicly listed companies, and the whole transformation is expected to be wrapped up by March 2026. But here's the thing. The demerger itself, that's just the first domino to fall. It's what this split unlocks that has investors so pumped up about where the company's headed. And you can see why, right? The logic is pretty solid. By splitting off businesses like aluminum and zinc into their own companies, the market can finally see what each part is really worth. That could unlock a ton of value. Then you pile on a serious plan to cut down debt and an ambitious goal to double production. Yeah, you can see why the bulls are running. Oh, and a cool 5,000 crore profit, which is about 50 billion rupees, plus the potential for a 36 rupee per share dividend. The optimism is definitely there. Okay, but you know the deal. It's never all sunshine and rainbows. So now it's time for a reality check. Let's flip the coin and talk about the risks, because they are definitely there and you need to know about them.
All right, before we get to a pretty scary number, we need to quickly get our heads around this term, pledged shares. Basically, it just means the main owners, the promoters, have used their own stock as collateral for a loan. If they can't pay it back, the lender can just sell those shares on the open market. Poof! And that can send the stock price spiraling down fast.
Which brings us to this number. And it's a big one. A whopping 56%. 56% of the promoters' own shares in Vedanta are currently pledged. It's all tied to an $80 million loan, and honestly, it's a huge cloud hanging over the stock. It's a risk you just can't ignore. So let's break it down, nice and simple. The bull case versus the bear case. On one hand, you've got that juicy dividend, the demerger unlocking value, and a ton of brokers screaming, buy. But on the other hand, you've got that massive promoter pledge risk, the crazy ups and downs of global metal prices, and a legal claim or lien on the promoter's shares. It's a real tug-of-war.
So with all these pros and cons swirling around, where do the experts land? What are the big brokerage houses saying about Vedanta's future?
Well, firmly in the bull camp, you've got big names like ICICI Securities. They're not just hopeful, they've slapped a buy rating on it and set a target price of 650 rupees. They clearly think there's still a lot of room to grow from here. And they're not alone in this. You've got other firms like Emkay who are also pretty optimistic, even if their target is a little more conservative, around that 625 mark. So the general feeling out there is definitely positive. But, and this is a huge but, getting the 650 or even higher isn't a sure thing, not at all. It all hinges on 2 critical things. First, This rally has to keep its legs. And second, and maybe most importantly, the company has to pull off this super complex demerger without a single hitch.
So there you have it. That's the whole story of Vedanta's massive gamble. It's a company at a major turning point, with incredible potential, but also some very real risks. The big question for you, after you've done your own homework, of course, is this. Are you going to be a part of what comes next? Have you heard